Welcome to Good Burger, the home of the good burger. Man, I take your order and turn my hat on backwards. Never try my hat backwards. Oh, invite Ashley. I don't think my hat backwards works. Try to.
Yeah,
How you doing? You're sideways. You need to turn it the
I'm
other way around.
I'm at sideways. Do you know
Yeah,
why? So I'm just gonna have to hold it. I
same.
was trying
I'm
to,
just gonna have to. I'm trying to do mine, but I think I'm gonna have to hold mine as well. To be honest.
yeah, I was trying to do a lazy one. You know.
Nah, I hear you. I hear you. How you doing anyway?
No, I'm good, man. You tied me down. You know, I mean, but normally, I'm. This is like a first for me, like on the live. So it's gonna be.
You know
It's
what? It's
interesting.
like yourself and my sister, my older sister. You guys are the first people. I think I'm like the first person that you guys have done these live with. Honestly, it's an honor. So
Yeah,
I'm glad
yeah,
that you're taking it upon yourself to want to listen to come speak to me. I appreciate that. Just
yeah,
gonna
yeah.
just give me 1 minute. Just gonna invite a few people just to get the audience going. If you could do the same as well, please, my man.
Oh yeah.
Let me just do.
How do I do it?
Oh, I forgot you're new to this. You literally just see the arrow. See on the
Oh
bottom. See
yeah,
the
the
arrow.
arrow at the bottom.
Yeah, click that, and then you're able to then kind of share it out. It'll tell you search and just click the circle next to the person's name.
Oh yeah. So it's the top. I wonder if I can do my whole contact list.
I'm
Or,
not sure, or you might have to do it one at a time, but you can keep clicking and clicking and clicking and clicking. David, what's
okay.
going on? I'm here with investment expert. You know what I mean? This guy
Well,
knows how to. Well, he knows how to break down perfectly the rules of investing and managing your money and black wealth and black finance. So yeah, I'm looking forward to actually getting on. But actually, we'll kick off in a second or so because again mainly it's just for the website recording anyway. So
yeah.
yeah. Let me get ready to go in a second. But how you been, Ashley? Though?
No, I've been good. Just been still working from home, and doing what I can really. Looking at the fallout as it goes.
Yeah,
I
exactly.
mean, I know the funny enough, I need to digest the budget. I know they announced some big things today.
Yeah, 500K now off the stamp duty, isn't it? That's big. Well,
Yeah,
well,
that's
really,
big,
it's not
isn't it?
necessarily middle class people, but it's not really still helping the economy because it's still going to be quite selective. But it's good stuff.
And the worst thing is, to be fair, well, I guess they're doing it to make a stimulus, aren't they?
Yeah.
Stimulus for the housing market. But they
Of
said that
course.
for the first time, house prices have gone
Did
down.
you see
So,
they've knocked the VAT in the travel tourism from 20% to 5%? They
oh, is
really
it?
want to, they really want to rejig the economy at the moment. They're really trying to get the economy back to normal. So,
That's mad.
yeah. So before we'll kick off anyway now, without further ado, please tell the people who you are, what you do, and what we'll be covering today.
Okay, so my name's Ashley, and I'm just a layman. So someone who's tried to over the years, I've dabbled in a few different instruments with regards to saving, investing, budgeting, and it's just something that I've been tracking and trying to upskill myself in, trying to teach myself, and always trying to learn, using everything as a learning opportunity, really.
Yeah.
So
So
so that's
I
me.
guess I guess for those watching, when I first kind of wanted actually to speak after I this year only really started looking at investments properly. So I have a few stocks, I have a few shares and a few companies. But speaking to Ashley, he breaks it down in such a way that it makes sense for you to get into it, and also kind of makes you feel silly for not investing in assets and shares and stocks. So if you were nervous or you're hesitant about putting in a bit of money, Ashley's going to break it down for us. So Ash, I guess I really want you to break it into start the early steps of why someone should get into the world of investment or just investing in stocks and shares.
Um, I think it's a good vehicle to generate gains and compounding interest. I
What
mean,
does
I think
compound interest mean? Just for those that don't understand it.
so the idea of compound interest is that you have a pot of money, you save, you earn interest on that money, or through if it's investing that we're talking about, you get growth on that money, And then the dividends that you receive or the additional money that you accrue, as you leave it there and as you add more, you actually then earn interest on top of the interest earned.
Mm, mm,
And
mm.
so in that respect, that is how your income, no, your wealth is growing
So wealth
as
is
you go
growing
along.
passively through interest that's accrued on your investments that you spend.
Yeah, and then in the terms of investments, if it's particularly stocks and shares, those are going to be your dividends that you receive.
And dividends are what a company pays you out based on the percentage of shares that you have. Is that correct?
Yeah, so based on the shares that you hold, dividends are a percentage of the profits, and so those will be all agreed in the annual general meetings.
Yeah.
And depending on the number of units you hold, depending on the share value, they will give you a certain percentage of their income. And so holding it, you actually holding it. It's almost similar to renting a house. If you own a house and you're able to rent it, the tenants give you money in return for that, in return for holding that house, if you like, and giving them the privilege of living there. And you, by purchasing your shares, you in effect own a percentage of the company. And so as for you holding that percentage of the company, they distribute a certain amount of their profits to you, and that's the dividend payment.
Okay. And I guess for those who want to get into it, how much would you say is a good start? I know this is a very subjective
It's
question, but
subjective. I
based on your
think,
corporate finance, but is there like a rough guideline number as to how much you should spend when you want to get into
well,
investments?
that's the interesting thing, because I think for me, you're right. It's definitely subjective, and I think it's relative to everyone's situation. And
Mm.
I think that's the key takeaway that I would give to anyone that was thinking about getting into it. I think for me personally, it's generally what you can afford, if you know what I mean, because obviously we've got our committed expenditure, we've got our bills to pay at the end of the day, and so you want to make sure that that is covered. Also, that you potentially have enough money to live on, to do your disposable income, to go out, to have fun, and then after that, you determine the percentage that you can afford to put away, and you're not worried about whether or not the value goes down, up or down in the short term. Because what you do have to remember is that your capital is at risk. I mean, when you put your money in
You
these
say that. What does
investment
it mean when your
vehicles,
capital's at risk? What does it mean when you say capital's at risk?
so capital's at risk in as much as it can go up and down. So if I put £100 in today and the share price decreases, then it stands to reason that my £100 investment will go down. But then also on the reverse side of the token, if that share price goes up, then you're going to be earning money. But I think with regards to that, I think the way I try to do it is drip feeding. And drip feeding is an investment tool, if you like, whereby you drip feed a certain amount into stocks in regular intervals.
A
And
monthly,
so,
like a monthly plan.
yeah, like
Have a,
maybe a
have a
monthly
certain amount
plan.
that you want to put, maybe 100, 200, £300 a month
Yeah,
into your share pile, that which
yeah,
then gets distributed to the shares that you're after.
yeah, exactly. And I mean, they even have other platforms like Moneybox, which many people might know, and that sort of chips away based on your spending. So I had that for a time. You link it to your current account, you spend money, and it rounds up the money that you spend to the nearest pound. But that money that you spend to the nearest pound, it puts it in a pot, and then it invests that on a weekly basis, and that's another form of drip feeding. So they
Okay.
also, so there are a series of apps, or if you go another typical way, you maybe get a platform, an investment platform, and then you set up a regular investing plan, and that's on a monthly basis.
Yeah, yeah, yeah. And so that's kind of what I'm doing at the moment when I'm with my partner Fidelity. So I guess with these kind of apps, the new apps that allow you to easily invest. So you've got free trade, you've got kind of these web apps, eToro. You have these kind of web apps. How like relevant or how good would you say those are, as opposed to signing up to like a broker like Charles Schwab and Morgan Stanley and
Well,
Fidelity and
it's
Hargreaves Lansdown, those kind of ones.
yeah. I mean, it's funny that you say that. I mean, whenever I'm picking any account for that matter, whether it be a current account just for normal day-to-day banking, whether in the past, whether I was picking cash ISAs or anything in general, I'll always go on like Money Savings Expert or other websites such as that to compare interest rates and compare, in the case of investing annual management charges and perhaps dealing charges. I think all of them offer a similar service. but then you have to look at the parameters of that service and decide what's right for you. So sometimes your annual management charge, that's a percentage of your holding that they will deduct in terms of fees that goes to the broker. And that's almost money. That's the cost of investing, if you like.
Yeah.
But
Yeah.
then you've got some places that have high annual management charges, but then your individual transaction fees may be lower. And so it's a real
Trade-off. Always
it's
a
a
trade-off.
real, yeah, it's always a trade-off because again, on Hargreaves Lansdown, for instance, because that's the one that I use, I know that it costs you £12 per transaction to buy shares. And you probably know that
Oh,
also,
a
don't you?
market something like that. Me, I'm gonna share.
Exactly.
No thanks.
You see what I'm saying? So, but then there may be other platforms where it's more favorable for share dealing. So if you're a person that's going to be doing regular transactions, and by that I mean maybe, and it's all based on your trading strategy. If you're going to be doing regular transactions, then you're going to look for a platform that's more favorable for that type of investing.
Yeah, yeah.
If you're if you're a buy and hold investor, then perhaps you may say, okay, the transaction fee is £12, for instance, in this case, but because I'm not going to be doing regular transactions, I'm going to buy this and I'm going to hold it for a long time. But also on Hargreaves Lansdown, another thing, if you regularly invest, that charge goes down to £1.50. And so that may be another compromise that you then see.
So that kind of leads me on to my next question. With all the kind of information and knowing what charges, having to look and read and see what the charges are for different different avenues in investment or different kind of like brokerages. How important would you say is could you break down the different types of investors that there are? You've got long-term investors, you've got what those called, the monthly income investors. Help us understand what different types of investments you can do.
So I think there's a whole wealth of information of this out there. But then when I first started to think about investing, I typically thought that people just had like a lump sum. And it was like, okay, I've got a lump sum, I don't know, maybe £5,000 or £1,000, whatever lump sum you have. And they just went out there, decided that they're going to buy the shares and left it. And that works if you've got a lot of disposable capital to play with. If you've got 50k lying around, and it's probably what some of the directors do, like company directors when they're doing on the FTSE 100, when they're doing their deals, they would probably literally take their big lump sums of money, buy their shares, and they can sit there and wait, because at the end of the day, they're not going to be lacking without that £50,000, if you see what I mean, because
so
they probably have
when it comes to investment, any excessive amount or any amount you can afford to lose, that's what you should put in, pretty much.
Yeah, I mean, any amount that you don't mind if the value goes down, because at the end of the day, if you see it and it's going to cause you pain to see that your investment has gone down, then you probably shouldn't be putting that amount in there so quickly. But then the good thing about drip feeding is, if I could afford £20 per month, for instance, and how I try to relate it to myself is, when things are all open and coronavirus isn't keeping us locked down, I could spend £20 a month, for instance, on a Nando's. That's easy. That's easily done. So if £20 a month is what you could afford, you could think, okay, if I just had one less Nando's, I could afford to put this and drip feed this into an investment. And you can't underestimate the power of consistency, because that consistent £20 over time, it really does accrue. I mean, I saw the same with the money box. I mean, money box chips at your savings every so often, and when it comes to the end of the year, it's like, oh wow, I've got £1,000 in here, and that's just come from chipping sort of £10 weekly into your account and getting the benefit of the investment growth. So with that, when you see the power of that, that's what really lets me know that it's something that I'm going to continue to do.
Yeah. And so, would you say income, so long-term investment versus immediate investment, what's the trade-off? What's the differences? What's significant? What isn't? Like with the benefits for and against, I guess both.
The benefits for and against what? So say that again, sorry.
So benefits for, we'll break this down. So benefits for and against long-term investing.
Well, for me, I'm really an advocate of the long-term investing, to be fair, because
Why?
I think for me, it's the time in the market that you really benefit from. I mean, if you've ever seen like a FTSE 100 curve of a company, you can see that it peaks and troughs and it's always rippling. So in fact, in this time, if you were to go on any sort of broker now, you would see that a lot of the curves are trending downwards. And that's just for the simple fact that we've been in lockdown for 3 months. The economy's really, really taken a hit and it's really ground to a halt. So in that sense, if you were to be buying now, you're potentially buying whilst it's on the downside of the curve. There's potentially still room for it to fall further. But if you continue buying on that curve when it does turn around, effectively you've benefited from buying at a lower price.
Yeah, yeah.
So then
And
long term gives you the chance to ride the ripples, if you like. If I put money in today, okay, it could. If I look at it tomorrow, given the current climate, it could have gone down. But then over sort of 5 years, if you've continued to buy it and the company's begun to turn around, then you're really realizing growth. But then that brings me into another thing, which I'd say is mutual funds. And the good thing about mutual funds is,
I want to separate ETF, mutual funds, all that.
oh,
Kind of
you're
thing.
gonna come on to
Yeah,
that.
yeah, we're
Oh,
going to
okay,
my
fine.
segments. Yeah. So
Okay,
get
fine.
to that. So just so the people understand, they'll get confused.
So with the short term
Yeah,
investments,
like just the monthly income investments.
well, but that's still a long term strategy.
Yeah.
So it's still a long term strategy. It's just that you're drip feeding your money into it gradually.
So monthly, so you're putting the money in, but every month you're taking money out as well. Your return from it.
Well, I wouldn't say that you're taking money out because you're still trying to benefit from the long term gain. I think
Okay.
what drip feeding does is it allows you to get a weighted average price that you're buying your shares at. Because if I buy it at £1 a share today, and I buy 100 shares at £1 a share, and then tomorrow those shares go down to 50p, if I'm still investing the same amount of money, I can now buy 200 shares for that same monthly amount. So then when you look at that's just over 2 months. So then when you look at your total amount of shares, you've got 300 shares now. And if you look at now, this is where my maths is probably going to fail me, but where's the numbers? I've spent 200
They're
pounds.
nodding like, yeah, I'm doing math, I don't care you.
Yeah, I spent £200. I've got 300 shares, and so the weighted average price is 66p per share. And see that over time, that's what you're really getting the benefit from by drip feeding.
Yeah. So you get a percentage of it out of every kind of share over time.
It's a weighted average, so it's hard, it's more so if you as you buy in more and more months. Sometimes you buy when the price is high, sometimes you buy when the price is low. But over that period, when you take the average, you'll find that you've the lows offset the highs, if you know what I mean, and then it's
Yeah.
averaged out. And so your price at that point is in the middle. So even though so you buy more shares when the price is low, okay, you buy a little less when the price is high. But then if you were to look at your price over over
5 years.
time,
Yeah.
yeah, you would see that it's a lot more steady. It's a steady line. It's not so jagged.
You're buying it at that rate, especially over time, as time and history have shown. Prices always steadily go higher over time. Anyway, all kind of stocks and things
Yeah, they
higher.
generally tend to trend up. I mean, and that's why when you see the government and it's all over the globe. They generally tend to put the economy as a high priority. I mean, you can only see just with how some of the treatment of things during this period that the economy is really prioritized sometimes over humanity. I mean,
Yeah.
it's not to say that that's correct, but that's 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 the situation that we're in. But the markets generally tend upwards, and so to buy into that, it's not a bad investment vehicle to grow your wealth.
Yeah. Okay, cool. No, thank you for that. In regards to the market, I was always taught this. The market is volatile. It's made up of investors' thoughts and feelings and reactions to things. So the market is very reactive. So prices go high and low based on what people think as opposed to what's going on, right? It's based on assumptions. So with that being said, I've always been taught this. See the market as a human being. So when a human's down, you can when you speak to a friend, hey, you're right, how you doing? You okay? And you notice someone's down, you're gonna spot someone's down. You're gonna try to do whatever you can. You're gonna react to how that person's feeling. So when the
Yeah.
market, for example, with Brexit happening, not Brexit, with Corona happening, we knew, for example, flights are not going to happen no more. So therefore, you should run if you've got shares in airlines, run. The market's upset, take them away quickly. That way you're reacting to it, right? So that's kind of how I was taught to determine and assess markets, see it as a human being and treat it as a very volatile thing full of emotions. So would you
Yeah.
say that is the same way we should look at markets also?
No, I think that is one of the, for me, that's one of the key mistakes.
Oh,
Because I think when you look at investing, you want to take the emotional response out of it. Because again, let's take, I don't know facts and figures, but let's take EasyJet for instance. When they announced that all of the borders were going to close, their share price probably did plummet. But a few weeks ago, when they said that they're going to open things back up again, I remember seeing it on my app, and I remember in one day they had something like 50% growth.
because
And
investors
so,
believed in it, right? Investors thought, yeah, this is good. So
yeah, because
people
it
started pouring
is.
into it.
Yeah, because it is all about sentiment at the end of the day and
Mm.
speculation. I mean, these brokers say on certain platforms, these brokers say, "Well, I think this is gonna hit £3 a share," and then another broker may say, actually, I don't think that's going to hit £3 per share. I think that's going to hit £2.80 a share. And then as more analysts sort of get on board with these sentiments, that's what then starts to drive the price. And I mean, obviously, there's other business activities that go on in the background. There's other metrics. There's other profit margins that the businesses have to generate. There's other things that go on within the inner workings of the business that actually govern what profits they're making. And then over time, the investors then begin to see, actually, you know what, this business is making money. They're forward thinking. There's scope for growth. There's scope to grow their profits, and that drives the price up because more investors then begin to get on board and say, yeah, this stock is a winner. And so, I mean, speculation definitely is a part of it at the beginning, but then there is a point when the companies actually have to back up what the people are speculating over.
So you're saying you take the emotion out, but then isn't that being
Yeah,
subjective then? Because you're saying take the emotion out of it, but that is kind of you're going by what people are thinking and feeling, what these analysts are
well,
saying, right?
Well, to an extent, I mean, as you get more experienced, or as I mean, and I'm not there yet, but as you get more experience, you probably start to really read like the inner metrics of these companies.
Oh, okay.
You read the inner metrics of these companies, and you go based on your feeling. In as much as you say, yeah, I think this is going to be a winner. But
Yeah, yeah.
when I say emotional response, what I mean is if you put your money in today and you see that it goes down, don't run to say, okay, you know what?
Oh, okay, got you.
Don't sell it straight away as a knee-jerk reaction, because if you've done the correct analysis, or if you've looked at the metrics and you think it's right for you, then you're confident, and if you continue to buy into that stock, whilst you may see it going down in the short term, over the long term, you may get the gains. And if you bailed out, then you've lost out on the growth,
Yeah, that makes sense.
or you've lost out on the opportunity that you thought you saw just because of an emotional response.
Just before, yeah, yeah. Okay, that makes sense. So it's kind of really just holding firm, right? If you believe in what you say and what you're about, if you've done enough homework on it, even if there's a little topsy downfall, continue to stay strong and firm in what you believe. If you believe will come true, then
Yeah,
still stick with it, ride with it, take the emotion out, and just go with what your homework and your analysis suggests.
yeah. And I mean, it's difficult to say because now the way this conversation is going, it's like we're talking about individual stocks. And
Mm.
so an
We're
individual
gonna get
stock,
onto yeah, all
oh
the
yeah, we'll get onto
yeah,
it.
yeah. We're
But
gonna get
like,
into it. That's
just
the
in
individual.
general, like an individual stock, that's like
Yeah,
putting all your eggs in
yeah,
one
yeah,
basket sort
yeah.
of thing. And so from that perspective, you could argue that it's risky. But then we'll probably get onto it later. But as you're
We'll,
talking about adding
we'll go
more.
on to that. No, we'll go on to that now. Just after this, but you're just kind of jumping anyway.
No, no, no. It's not even so much jumping. It's just
But it's
it's just
leading
to
into it.
qualify
It's
what
leading,
to
yeah.
say. Yeah.
What we're saying is leading into it. Okay, so I guess now, if you could explain to us what ETF is, so exchange trade trust. I think it's
This exchange traded fund.
yeah, exchange traded funds. If you
Um,
could tell us what the mutual funds are. If you could explain to us what these different types of funds people can invest in.
yeah. So an exchange traded fund. Well, yeah, I just said what it was. ETF, exchange traded fund. So that's a fund that trades on the live market, but that's effectively a collection of stocks. So an investment company
So see it as one house, and inside of that is plenty of houses with
is,
different
yeah.
stocks.
Well, so many. Okay, let's take America for instance. You got the S&P 500. That's an
What's that
ex.
for? What is S&P? Just for people to understand
So
that.
the S&P 500 is an index of US companies. And so I believe it contains 500 of the top US companies.
Okay.
And so within that ETF, you're investing effectively. If you invest in the S&P
And then,
500,
yeah,
you're,
that which
you,
is an ETF, right?
which is an ETF,
Yeah.
you're investing indirectly in 500 companies on that US index, right? And so when you buy an exchange traded fund, you might buy one unit of that, and that will have a net asset value, which is the combined value of all of the companies that traded on that stock exchange. As the companies in America go up in value, so too does your investment. And that's where you come into the point where you're discussing diversity. And that's a good position to be in, because you may be, if we take the airlines, your airline company may be trading on that stock exchange. And when they announce something like coronavirus, they're locking down, you may see that your airplane stocks, they all crash. But then at the same time, your oil stocks, they may still be going up. And then that's where you get the benefit of diversity by putting yourself in these exchange traded funds. A mutual fund is similar to an exchange traded fund, but the only difference is that they calculate the value every day. So there's a set calculation point, and at the end of the day, they update it. If your net asset value has gone up, then you'll see that reflected in your portfolio balance. If the net asset value has gone down, again, you'll see that reflected as a minus in your portfolio balance.
Okay, and got, you know, see, now understanding what ETFs are, mutuals, and obviously individual stocks, which everybody gets. How does a person become go from a good investor to a great investor? So what I mean by that is, how do you spot an opportunity? How do you what homework or what things do you have to look at in order to determine whether something is a promising stock, good stock, bad stock, that kind of thing?
Okay, that's interesting. Again, this is still something that I'm trying to teach myself.
Yeah,
but I think firstly, you look at the sector that the company is operating in, because you're going to have different types of businesses. So you've got a bank, for instance. And funny enough, this is one of the mistakes I made when I first started. But you've got a bank.
Good, let's learn. Let's learn from this mistake. Come on, say it, let's bring it.
Yeah, no, you've got a bank which is very sensitive to the market conditions, right? And so I think, at what time was it? I think it was Barclays, funny enough. It was Barclays. Now, when I was first starting out, I thought, oh, Barclays, they're a renowned company. They're never ever going to go under. And so I think it must have been 2 years ago I invested. And at that point, it was £2.30 per share. And, and no word of a lie, it wasn't until 2 months ago that I saw that stock come out of the red for the first time.
I hate banks. I won't give my own opinion, but I hate banks. I will never invest in a bank. Never.
Yeah. So, but I mean, in the end, it turned out to be a good story, because as a result, I stayed in. And when the price went down maybe 3 months ago, I bought a whole load to benefit from that drip feeding and getting that weighted average pricing that I spoke about earlier. And so now, those shares that I hold, they're actually gone up in value, because I bought some at £2.30. It crashed all the way down to like 70p this year. So you can imagine the type of
I would have been falling.
you can imagine the type of negative that I was seeing. But
especially
then,
if you bought over 100 units.
yeah. But then when I was looking at, I was watching some videos and trying to read into how to look at these banking stocks, and they had, I'm not going to name them now because I've forgotten the metrics. I'd have to research it and to quote them out. But when I was looking at the metrics, it looked like Barclays. It looked like their numbers were tallying up to say, yeah, it's gonna bounce back somewhat, because of the money that they had put aside to manage the fallout of the coronavirus. Their profit margin was still very strong. Even
so
with,
you look at the profit margin, so just based on what you said, it sounds like you look at the profit margin, the balance sheet, and you kind of look at their trend. Am I correct?
And you also, there's something called the price to earnings ratio. The price to
sorry.
So that's the price of the share relative to the earnings. The price of the share relative to the earnings per share.
So could you simplify that even more, please?
So the company's got a certain amount of profits per year, and that's their revenue. And then when you compare it to, so that's the earnings, and then you've got the price of the share as such. So when you divide those two as a ratio, you've got the amount that you're earning as a company in terms of monetary value relative to the number of shares that they have. And so when I was looking at the PE ratio, that is a good indicator that the stock may be undervalued. So if you've got a low price to earnings ratio, the stock may be undervalued. And so when I saw that low PE ratio, I said, okay, you know what? It's been negative for so long. I'm gonna take a chance. I'm gonna take a gamble.
So as their PE ratio is quite low, most people would probably just pull out and think, you know what, this PE is way too low. So if the PE is high, so like the shares per ratio, so the shares are higher than the price that you got them, that's a good sign.
I mean, well, yeah, you've got to look at you've got to look at multiple metrics at the same time, because if you look at Amazon, their PE ratio from memory is something like 200, which means effectively that you have to spend £200 to earn £1. But that's just because people think that. Yeah. But if you look at the share price of Amazon, the share price of Amazon has gone crazy. I mean, it's to be fair, it scares me. Like it scares me. I mean, I'd love to invest in Amazon because the amount of growth that they've had over these 5 years is just, it's phenomenal. It's exponential. But then it's like people really think that Amazon's going to take over the world. And for me, it feels like a bubble that could burst.
So we're talking about bubbles. We look at Tesla, we look at Amazon, right? Tesla's the same. Yeah. Tesla's is too volatile. I was so close to investing in it when it was $300 a share, and then it shot up to about 895. That's when I said, in 2 days, I said, nah, I'm not doing that. For me, that's a bubble. When Elon Musk, the founder himself, came out and said, I think my share price is a bit too high. For me, I stayed away. That's when I said, nope, I'm not going near that. I think it's when a regular Joe who has no idea about it comes and tells you that something's a good stock, you know to run away from it. Run away from that kind of share price, or run away from that. But Amazon, 4 years ago, it was $700, and now it's about $2,500. So
it's something crazy. I mean, that alone shows you what the scope is for investing. But I've always found that by the time someone's telling you about an investment, you've probably already missed the boat. Because I remember when it was Bitcoin, for instance. Like there was a time 2 years ago when Bitcoin was about £14,000. I remember it was somewhere in December at Christmas, and at that time, everyone was like, "Yeah, you know what? I'm gonna buy Bitcoin. I'm going to buy Bitcoin." And I literally remember I was thinking I'm going to do it as well. And I think I came back after the new year, January, and within a few days, the price had crashed to £6,000. So literally, if you would have put your money in there, you would have lost half of your money. But again, Bitcoin is something else. That's probably going into cryptocurrencies and a bit more into forex trading and so on.
And so, I guess, so in regards to all of that and knowing kind of what you know now and, explaining what makes a good stock. So again, it's looking at the PE ratio, looking at the balance sheet, and looking at a company's debt. And also, I guess, customer loyalty is really important as well, isn't it? When it comes to looking at whether to invest in something or not.
Yeah. I mean, again, you're really taking a view on how you see the business. And that's something that's really subjective to an individual investor, if you like. And that's why it's always hard to give a distinct formula, because as everyone begins to read and as everyone begins to teach themselves, they're going to have their own idea of what they think is going to be useful. So for me, it could be, you know what, let's look at the current climate with regards to energy efficiency, for instance. I know because of my daily activities and my job, that by 2050, there's a drive for net zero carbon, and that's just trying to take the amount of the carbon out of the energy that we use. So then if a forward-thinking company were then to come out with something that is going to help that agenda, then that may be somewhere that once you look at their financials, you may say, actually, you know what, it looks like they've got a forward-thinking agenda, and so this may be a company to invest in now, because in the next 5 years, this is going to be a hot topic, and they seem like they're already ahead of the ball. And that's the sort of information that you're getting from reading their general reports, understanding what they are as a business. Because that's another thing that you've got to think about. When you're buying shares, you're actually buying part of the business. So it's a concept that I took from a video that says, when you actually buy the share, think of it as the fact that you're buying this part of the business. Is this a business that you believe in? Is it?
So it pays to be invested in that role, in that opportunity, that business, and what they're doing, and kind of knowing what's going on with them. So do not just invest to invest. Actually, do your research on them.
Yeah. It's actually doing your research. I mean, I think another approach that I take is it's not a get rich quick scheme. I mean, for me, I'm not sort of investing in any company to think, oh yeah, I'm going to get rich quick. It's going to blow up, and I'm going to be a millionaire. It's more so really, I'm more so using it as a vehicle to generate some form of safety net for when I'm hoping to retire. And so
Yeah.
it's really a long-term vision, moreover than I'm going to throw this money in here and hopefully it's gonna blow up and then.
So what would you tell people who are, I guess, hesitant about investing? They've got excess money, they want to do it, they're hesitant about it for a myriad of reasons. What would you say to kind of help, not convince them, but just push them over the edge, or just make them see another way to things as to why investing is a good idea?
What I'd say is, I think where I started from a place where cash was king. Like for me, I had cash in my bank account, and I was just like, yeah, I love this. I didn't want to risk it. I was against risking it in any way, shape, or form because, like, to have the money there in the bank, I was always told that's the safest place for it. Like, no one can take your money, and the bank's going to give you interest on that money. But then, as I started to look into it further, and then started to understand the inflation, it's like you're losing money putting it in the bank anyway to a certain extent.
Yeah,
Because
money's dead. As soon as the inflation hits and interest goes high, your money's just dead. Like, as
well,
long as
especially
inflation is living, your money's dead in the
well,
bank.
it's funny because I think when I first started, there's something called the England base rate, which a lot of all the interest rates from any bank account, they're all tied to this England base rate. And like a few years ago, that base rate got slashed to like 0.5%. And I think it even got slashed to 0.25% at a time. And it's like what I started to notice, I started to notice getting like letters through the door saying, yep, your interest rate's changing. It's going down from 5% to 3%. And then I got another letter, it's going down from 3% to 1%. And then I got another letter saying it's going down from 3% to 0.5%. And then you're like, hold on a minute. So I'm getting 0.5% interest and the rate of inflation is 2%.
It's 2%. And I've
So
held my money in my account for 10 years and nothing to show for it.
yeah, so effectively, all it means is that the money that you're holding this year, by the time you get to next year, you've already lost 1.5% of it anyway, just because the spending power of that money has gone down as a result of inflation. And so that would be, if you were nervous about it, would be if you can put it in investments. And I always try to analyze it with a modest growth figure, because I always try to say, if I'm ever doing any projections, I always try to say, you know what, let's see if it grows by 5%, then that's good. I mean, there's talk of people achieving 13% growth, but I try to manage my expectations when it comes to these things.
Okay, cool. And then I guess from your kind of high experience, is there any kind of one stock? It doesn't, again, this is not to influence anyone's decisions whatsoever, but is there any stock you have regret for, so you wish you had invested in it when you had the chance, but you didn't? For me, it will forever be 4 years ago, Games Workshop, 4 years ago. If I had invested even just 3K in it in 2016, I would have had 40K, 45K in my account.
Do you know what? It's
That
you.
upsets me to this day. Especially
You.
that upsets me to this day. That one.
I think it was you that told me about
I told you
Games
about Games
Workshop.
Workshop. Yeah.
Yeah, and when I
I told you many years ago about it.
and when I saw when I saw it, I was like, wow, like this is mad. Like that graph is crazy. But
It upsets me every time I read it. I'm like, oh, like I had the chance to buy a lot of units in it, and I just, but again, I wasn't. It's the ignorance. This is why education is so important. I didn't pull the trigger. I didn't know enough to want to put myself forward. And of course, 2K at the time, to a young guy, you're thinking it's a lot of money. I'm not really sure I want to lose that. And now to know that I could have had 45K worth of shares, kind of hurts.
it's a hard one because I changed my strategy for the time being to adjust my portfolio to have more mutual funds. So again, when in the beginning, I fired out some random investments on, say, BP, Shell, Barclays, Tesco. who else? There's Glencore and Rio
Yeah.
Tinto. And these are, I threw them out there just thinking, reading a bit of the Financial Times, seeing what some of the investor sentiment was, but also with the naive knowledge that, you know what, these are big companies and nothing's going to go wrong. I got lucky. But as I started to delve into it more, I really started to like the idea of geographical diversification. And so I haven't gone into individual stock picking yet as such.
So
But
you're still doing ETFs, mutual funds. That's
yeah,
what you're on.
I'm still doing
Indexing.
ETFs, indexing. So a combination of indexing and a combination of a fund that's aiming to beat that index. And so that's where I've more positioned myself. But if I were to relate, there is one index fund that I looked at, and I said, actually, I'm not going to put it in there. And if I check today, it's on my watch list, in fact. And if I look at it on my watch list with the amount of money that I'm going to put in, no word of a lie, it said it's grown like 85%. And and that's in 1 year.
No one can tell you money or opportunity is not there. Nobody can tell you there is not time to make money. If you just, as long as you do your research, there is goodness to make money. There is opportunities to make money. 85%, that hurts. That hurts.
Yeah. So I mean, if there was one that I regret, it would be that one. But at the same time, again, I don't really see it as a regretful experience, because I think from it I learned. I mean, even if I look at the basis that I said, if I look at the mindset that I had when I said, yeah, this is a good stock, I can apply those principles to find another one, if you follow me. And so it's all a learning experience from that perspective.
So what would you say? What are your, again, purely your opinion, not no one else's. I have to keep saying that because I don't want anyone to come back and figure, oh yeah, I done this and it didn't work. What would you say are your hot industry stocks to invest in?
Do you know what? For me, the biggest powerhouse is the US index. I mean, from I started to put myself in that US index.
Same, yeah. I've invested in the S&P 500. Same.
Yeah.
I've had constant growth, constant growth.
Constant growth, and the good thing about it is it's passive. Like when you look at the investment costs of investing in that one, it's amongst the cheapest, like something like 0.06%. Because it's passive, because the person that it's not managed, the person literally they literally buy all of the constituents of that index, and it just adjusts to track the US index, so to speak. And so that one's been my favorite, because in fairness, there's not many active fund managers that I've seen that can beat it. I mean, there are some. There's Lindsay Train, who I've seen his, and these people are sort of trending like 300% growth over 5 years, sort of thing. And so there are people that beat it, but I mean, compared to the US index, that's doing something like 150% now over 5 years.
And if you look at, as history's shown us, if you look at stocks that are already doing well, chances are the Apples, the Ciscos, the Facebooks, they're going to be there in 5-10 years. They're going to be doing really well.
Yeah, I mean, the way their management structure is, they're always pivoting to adjust to industry, and so they're so forward thinking. I would hazard a guess to say that they are still going to be there.
So if you could recommend one that somebody wanted to be interested in, could you do that, or would you do I could recommend one. I'm happy to recommend one stock which I think people should take a look at. I'm not saying invest, to take a look at. And I
what one?
Why? Do you want me to go first?
Yeah, go on. And I'll try to think.
I would, for the people, I'd recommend Cisco. And the reason why I recommend Cisco as a stock to watch is because with 5G rolling out, don't forget, Cisco own at least 95% of the world's networks. And so Cisco will be the primary company rolling out 5G across the world. So as you can imagine, Cisco stock is going to be very, very good in the next 3 to 5 years. So that's just something I would tell people to watch out for, purely because I know with 5G rolling out, and that's going to be, again, the world's infrastructure. Take a look at who's going to be running the world's infrastructure. Think about how in demand Cisco services will be, especially as they're buying up a lot of these 5G companies and they own the networks on top of that. So that's why I would say Cisco is one of my ones to watch for people.
I'm trying to think. It's hard. I mean, as I said, I probably couldn't give one, because for so long I haven't actually delved into individual stock picking. But from
you can give an ETF or mutual. if that's
An
easy enough.
ETF. Do you know what? There's one called Fundsmith that I'm in, and that one's really impressed me in terms of how it's held up over this period. And it's more so the investment strategy that I'm buying into, because they're analysts at that company. They say, listen, I'm going to buy these stocks and hold. Their whole strategy is buy and hold value stocks that offer dividend growth over time and that pay consistent dividends over time. And I mean, considering all of the market crashed, I think I've been invested in that Fundsmith for coming up to 16 months now. Yeah, coming up to that's not an ETF, by the way. I just saw it in the tag. That's just a
Oh, my
mutual
bad.
fund.
Mutual
But
fund. Sorry,
yeah,
sorry.
that's a mutual fund.
Yeah,
But I've been invested in that one for 16 months, and I believe the growth is at 15%,
that is not bad.
which
Over
is
what
not.
though?
Huh? That's
Over
over
how long
50.
has that been?
That's over 15 months,
That is not bad.
which is not bad considering
Yeah.
that it would have been. It probably would have been better if the economy was functioning as it should have done. I mean, again, I had to weather some storms where I saw that was deep in the negative, like deep, like it was -3 at a point, and then it's steadily sort of come back up, and that again sort of reinforces their strategy that they're investing in value, and so over time the value is going to be king, and they're going to be able to recover in even in a time like this.
Yeah, cool. All right, then. Thank you very much for that, Ash. I think you've given us a lot of really great insight into understanding, kind of how to get into a lot of stocks, why you should invest in stocks, how to look at stocks and the different types of stocks that we have. I mean, I'm going to open up now to questions from the people, if you don't mind, Ash.
Yeah, that's fine.
So we've got one from Heathful Panda. He said, with all of your commitments considered, would you be able to put a percentage to how much someone who's new to investing should be investing? So, example, could it be like 10% of your monthly earnings?
Now, for me, I think another thing that I like to do is I like to get a spreadsheet and sort of start to understand what my outgoings and what my incoming and outgoings are. And I think once you do that, then you can decide for yourself what a good percentage is, because again, all of our living situations are different. Some people have rent to pay, they've got different commitments. Some people live with parents, and they may be able, for them, the proportion that they can allocate may be higher. But I think for me, a good indicator per month is 10%. I think that's what they even say you should be paying into your pension monthly. So if 10% is a good, 10% is a good sort of ballpark figure to aim for. But again, it's subjective. I mean, if you can't afford 10%, then it's based on what you can actually afford. And I think that would be the key advice, because you don't want to sort of shoot yourself in the foot, because the whole idea of this is that the money that's going there is going to be held there for long term.
Rule. I don't know if you've heard of that. Actually, the 4% rule or something. In terms, I forgot how you do the calculation, but something divided by the 4 weeks in a month, and that should be how much you.
Oh,
you
I
put.
haven't come
Something
across
I've
that
read
one.
it somewhere, but no, I agree with you. Just to kind of add to that, 10% for me is how much I put.
Yeah, I mean, I think to put it into perspective, I think the government some while back asked that it was 8% that you're contributing at your workplace pension, wasn't it? And I think generally people know that even that 8% is sort of widely known that that's not going to be enough, if you know what I mean. So 10% for me is still a good ballpoint figure, and I think that's probably a little more that I do, but okay.
Cool. Thank you very much for that. Actually, we've got another one. Do you have advice as to where anyone looking to start investing should be looking right now, considering the current economic situation?
When you say that, do you mean looking at in terms of platforms, or do you mean looking at in terms of actual stocks?
Let's say both.
So if you wanted to look for platforms, a good website of mine is just Money Savings Expert. They will break down the different costs and different charges associated with the different platforms. And I mean, you've got AJ Bell, you've got Charles Stanley, you've got Hargreaves Lansdown, which is one of the more expensive ones, but is the one that I use. And that's mainly because I like their user interface and I like the information that they provide. So they actually provide analyst reports to you if you sign up. And that's useful to give you some invest in inspiration. And then in terms of where I'm actually looking, for me now, I'm actually looking in the UK because if I look at portfolios, I can see that the UK stocks are just trending very cheap now, just because of how the UK economy has
Yeah.
been affected. Now, I think the UK now may be the fifth or the sixth biggest economy, but I would hazard a guess that the fundamentals of the economy aren't, well, again, it's changing every day. Before this coronavirus, I would have said the fundamentals of the economy aren't terrible. And so you would expect that over time it would trend upwards. At the moment, we've still got to assess the fallout of COVID-19. But for me, I would still be buying the UK stocks while they're cheap because I have the sentiment that they're going to return to where they were before we got into this mess. And
And with
so,
it, of course, being Brexit, it's going to be a whole new ballpoint, and the disconnect,
well,
and especially if it's doing direct partnership with the US, stocks will shoot
well,
through the roof.
yeah, I mean, it's funny because I mean, when Boris got elected and got into power, I saw the stocks shoot up, and that was what they called the Boris bounce, and that was simply because for once the country had certainty over what they were going to do with Brexit. Because before there was a big level of uncertainty that meant for the large proportion of last year you didn't see much growth in the UK stocks. But as soon as we got that conviction to say, I mean, Boris came in and he said, well, that means we're going to leave. Not that I'm an advocate of Boris, by the way, but they said that when he came in, the country had a certain direction as to where they were going to go, and the conviction in the stocks went up.
Yeah, no, definitely. Thank you for that. Ash. Got another one from Naomi. She said, "What do you prefer, ETF or index?"
That's a good question. I prefer index, but it's funny because a lot of the ETFs are indexes. So
Yeah.
I think in terms of an index is more of it's a passive fund, and it means that you can put it there. You can rest assured that your money is diversified across. If it's the FTSE 100, it's 100 companies. If it's the FTSE 250, it's 250 companies. If it's they've got a FTSE 350, that's 350 companies. These are all indexes, by the way. These are UK indexes. Me, I love the idea of index funds. They're cheap to invest in. You buy into the fact that markets tend to trend upwards, and you've got diversification across different sectors and different companies.
For me, yeah, that I would definitely say. But you know me, Ash, I'm a risk taker to the full. I like my individual stocks. Do you know what I mean?
Oh yeah,
I
I
feel like
mean,
the quickest way to make a mill, have 20 individual stocks and just say F it, put
well yeah.
whatever you fancy it. But it's not a good way. That's just my way, everybody. I'm
No,
just
no,
saying, like,
no.
cool.
I mean,
I've got two
it's
ETFs, I've got one mutual, and I've got like 8.
I mean,
I'm going for it all.
no, but that's good. I think everyone assesses their risk profile, and if you're a person that likes to take risks, then you can go that way. If you're a bit more
In the
guarded,
words
if
of
you're a
Meek
bit more
Mill,
balanced,
in the quote, the great philosopher Meek Mill, "Scare money don't make no money." So
yeah.
that's kind of the mantra I'm living by right now. I'm not gonna lie to you.
I mean, if you're balanced, if you're balanced, then you might go for mutual funds. But if you're willing to risk it, then yeah, you can go for it. But then the key, even when you say you're willing to risk it, I bet the key thing that or you would agree with is that you're not worried or you're not concerned.
Oh no! If I'm to lose it, I'm to lose it. I mean, don't get me
Yeah,
wrong.
you want it, but
So yeah, it's substantial money. I want it, but at the same time, if I'm to lose it or it go half, at least I know I tried. I don't want to live in regret of thinking, oh, I didn't go for it. And then if it does pop, then I'm like, yeah, cool. And if it didn't, I believed in it. I think you're right. What I really liked your point was believing in what you're investing in as well, living by that conviction. So I believe in myself that these stocks are worth it. So I'm going to go and try these individual stocks and take the risk and say, you know what? If it works, it works. If it doesn't, it doesn't.
yeah.
So no, I definitely believe in that. And again, individual stocks are the quickest way to make a lot of money. If that's what if you're looking to play the long term and short
Yeah,
term game.
I mean, to be fair, just to give an idea, I mean, I did on the shell stocks. The good thing about individual stocks also is that they pay you a dividend directly into your account, and so you got two things. You got your growth over time, so that's just the share price going up, but then you've also got the dividends that they pay you, and owning these value stocks or owning them, you're going to see two streams of income, and that's sometimes good enough to see as well. Oh wait, I've lost your sound. Hold on.
Sorry, can you hear me now?
Yeah.
Yeah, I got paid my first dividend last month of 23p. I felt great, man. I just felt like I'm up in this world, you know. I'm coming. Give me
Yeah.
10 more years, I'm coming. That's gonna be £1. Give me 10 more years, I'm coming.
Yeah. It's all
And
it's all a journey.
I guess last question as well. So when you see the value of something, for example, is the value of what you see on your screen what you can actually pull out of out the bank? Because I know in some instances that's not the case, is it? It's, people need to learn to understand to read what it means as well, right?
Oh
But for
yeah.
example, I can see a stock and it could say, oh, the value gain loss is £400, but that's not necessarily how much you can pull out or how much it's actually worth, right? So how does that work?
Well, if you see the value of your stock being worth £400, the only thing that will come out of it when you sell it are your transaction fees.
Okay.
So if so again, depending on what platform, I'm only talking HL because that's what I know. If I
Yeah.
saw £400 on a certain stock and I sold it, I know that number one, it's going to find me the live price as per the market. So it will generate a quote, and what the live stock market price is, it's going to return your figure, and then out of that figure, you got your £12 transaction fee, and in some cases you even have your stamp duty on that. So then those your stamp duty or your tax, it comes out of that. But if you're investing in a stocks and shares ISA, that's a tax-free vehicle, and that allows you to get over some of these charges.
Cool. Okay. And I guess just last question is, us being from the black community, it's important that we really need to get into stocks. And how important would you say it is for our legacy, right? Because I know for people wanting to get into it, wanting to do it for their kids, wanting to do it in the future, just thinking about, I guess, setting up, for black community, how important would you say it is for us as a people to really get into this?
Um, I think it's definitely one to consider. I mean, when I was talking to some of the people at my workplace, and when they were telling me like what their fathers left them, sort of thing, or their parents left them, it's like they'd left them like investment portfolios for them to take on. You know what I mean? So when you start to talk about generational wealth as such, if you're in a position to be able to give this sort of portfolio, or even give the discipline to your offspring going forward, then it can be powerful. I mean, again, there is some empowerment that comes from being financially free, being financially mobile, being able to maybe it might be that you're interested in starting your own business, and so you've got to invest in your own business using capital that you've raised. And so it is linked to empowerment. I mean, I never try to preach that money is everything, because I really believe it to be a tool to achieve certain things that you want. But the benefit of being able to give that philosophy, or being able to and effectively give that value to your children and then pass it down, I think if more of us can grasp it, then yeah, it'd definitely be valuable.
Thank you. With that, Ash, we've got 1 minute 50, so I'd like to thank you very much for being on the panel today. You dropped us hella insights, just knowing about stocks, understanding it, why it's important for us, how it builds, how to look at it, and how to understand it. So I'd like to thank you very, very, very much, Ash, for being on the panel today. Is there any final questions you can wrap up? Sorry, final last words that you can wrap up in like 20 seconds?
No, I mean, it's a difficult one. I mean, for me, I think for everyone, just look into it, look at what you can do, assess your incomings and outgoings, and only invest what you're comfortable with, and give it a try. I mean, there's loads of apps out there and you can start slow. You can start with a very cautious portfolio, which might have a series of bonds, and that's more secure than equities. If you're like you, then you can go straight in and risk it for a biscuit. So yeah.
Come on. Chocolate biscuit as well, mate. Let's not forget.
Yeah.
But no, on top of that, thank you very much, Ash. Really insightful, really helpful. And for those, please do share it out. Please do check out the Spiela community. Please do follow us. Please do support. We do a lot of these cool things with really cool people like Ash. So Ash, thank you very much, my boy. I'll give you a shout soon anyway. But long live, keep hustling, keep risking, and everybody have a good night.
Yeah.
Take
All
care,
right,
Ash. Cheers,
yes.
bro.